Okay, let's unpack this Bitcoin thing. December 2024, it punches through, what was it? $2 trillion market cap.
2 trillion, yeah.
Just let that sink in for a second. I mean, that's bigger than huge companies like Tesla, Meta, even Saudi Aramco. It's monumental, right?
It really is. And yet,
You've got this Nobel Prize-winning economist, a really respected guy, basically saying, nope, it's going to zero, like within 10 years.
with the contrast, isn't it? It really shows you how, well, how uncertain this whole digital asset world still feels, even now.
Absolutely. So that's what this deep dive is all about. We're going to plunge into this, this really complex world of Bitcoin and cryptocurrencies.
Right.
Our mission really is to understand the arguments, both sides, for and against, their value, their future. Are they sustainable? All that stuff.
And we're not just spitballing, as you said.
Yeah.
We've got quite a bit of material to draw from.
We do.
We'll be looking at a Capitalism's podcast chat featuring Eugene Fama, the Nobel laureate you mentioned. He's famously skeptical about markets, especially things that might be bubbles.
Okay.
And there's an article from River asking, point blank, is Bitcoin just a Ponzi scheme?
Ooh, provocative. Then we've got this Crystal Intelligence report. Pretty sobering stuff on the huge crypto hacks. Billions lost.
Yeah, staggering numbers.
Plus, a piece arguing against crypto from Denkin.io, something from the LSE Business Review on the environmental side.
The London School of Economics, right. The energy use.
Exactly. And a very lively Reddit thread. Go to look there, right? Asking, why is Bitcoin a scam? And finally, a warning from ESMA, the European regulator.
So quite a mix of views, some really strong opinions in there.
Definitely.
The challenge for us, and for you listening, is how do we sift through all this? How do you form your own informed view without getting totally overwhelmed?
That's the goal. Help you cut through the noise. Okay, so let's start with basics. Cryptocurrencies. What are we even talking about? Bitcoin's the big one. The first one started this whole revolution. Frenzy.
Well, the capitalism discussion defined it pretty clearly. It's basically digital money, right? But it works without a central bank or government. Uses a decentralized network, usually blockchain.
Right. No middleman.
And yeah, Bitcoin was the pioneer. Still the biggest name, takes up a huge chunk of the market value.
But even from the get-go, there were worries, weren't there? I remember the capitalism folks, Fama included, raising red flags early on.
Yes, and some of those early concerns are still front and center today. The massive energy consumption for Bitcoin mining, that was flagged immediately. We're talking, what, Poland's worth of electricity annually?
Poland's worth? That's huge.
It is, yeah. And also Bitcoin itself, its design.
Yeah.
It doesn't really do complex stuff like smart contracts easily, not like some newer ones like Ethereum.
And the comparisons they were making, a bit funny, actually. Beanie Babies. Remember those?
Yeah, the idea being the hype was similar. People thinking these little stuffed toys were going to make them rich.
So they jokingly called crypto babies or crypto beans.
Kind of, yeah. Just to highlight that maybe the price isn't about real use. It's just speculation. Believing someone else will pay more later. That greater fool theory idea.
And you see that speculation play out, right? Like, President-elect Trump launching a coin, Melania Trump having one. It feels a bit Wild West sometimes.
It definitely feeds that narrative of a market driven by hype, perhaps more than fundamentals.
Yeah.
And capitalism also mentioned things like stable coins, trying to be stable by linking to, say, the dollar and then
Like,
meme coins.
Yes, that's corn.
Often called that, yeah.
Sorry.
Little apparent value, just riding internet trends. So it's a real mixed bag out there. Some trying for stability, others pure meme fuel.
Okay, let's bring Professor Fama back in.
Right.
Nobel winner, efficient markets hypothesis guy. This is where it gets really theoretical, but also very critical of crypto.
Right. His efficient markets idea, which goes way back to the 50s, basically says stock prices already reflect all known information. So beating the market consistently is really, really hard unless you take on more risk.
Makes sense.
So his advice usually is, for most people, just invest passively, index funds, that kind of thing. You probably don't know more than the market already does.
Okay. And he takes that same skeptical view towards bubbles.
Very much so. For him, a bubble isn't just prices going up fast. It has to have a predictable end. And if you can't predict the pop,
Then you're just using the word bubble loosely.
that's his argument. He apparently even canceled his subscription to The Economist because he felt they used the term too much without defining that predictable endpoint.
Wow. Okay. What about historical bubbles then, like the Dutch tulips?
His response there is pretty cautious. Basically, I wasn't there. The data is often shaky. How do we know what the right price for a tulip was back then?
Fair point. Hard to judge centuries later.
It highlights how tricky it is to label things definitively. He also struggles with this idea of intrinsic value, what something is really worth fundamentally. He finds the calculation difficult, especially with changing discount rates.
Right. So let's get to his main beef with crypto as currency. He says it fails as a medium of exchange. Why?
The core problem for FOMA is the volatility. The value just swings too wildly.
Like up 10% one day, down 15% the next.
Exactly. How can you run a business like that?
Yeah.
Pricing goods, paying salaries. If the value of your money is bouncing all over the place, it's just not practical for everyday transactions. Too much uncertainty.
Okay, so if it's not great as everyday money, the argument then shifts, doesn't it? People started saying, well, maybe it's not currency, maybe it's an asset, like digital gold.
That's the pivot you hear a lot.
But FOMA's not buying that either.
Not really. His comeback is basically gold is gold because it has uses jewelry, industry, etc. For something to be digital gold, it needs some kind of use beyond just hoping the price goes up. Otherwise, he says, it's just air.
Digital air. Ouch.
Pretty blunt, yeah.
But then in that same capitalism discussion, Luigi, and he made an interesting point, right, about oligarchs or people fleeing instability.
Yeah, that was a different angle. Luigi suggested that even if Bitcoin crashed, say, close to zero, for someone needing to get wealth out of a country quickly and easily, maybe bypassing controls, it could still have value for that specific purpose.
So a niche use case, even if it fails as mainstream money or gold.
Potentially. Which brings FOMA back to the basic question. Where does the value come from? Is it like gold with real-world uses? Or is it just convention like Yap money, those big stone discs used as currency on that Pacific island?
Because people agreed they had value.
Exactly. But FOMA would stress do things like Yap money or Bitcoin have these massive, unpredictable value swings. That's the killer for him in terms of reliability.
Okay, let's switch gears a bit. Let's lean into the skepticism. The is Bitcoin a scam angle. That Reddit thread, or Buttcoin, they don't exactly hold back, do they?
No, they certainly don't pull any punches over there. A lot of the arguments are pretty direct. Many see it as basically a zero-sum game, or worse, negative-sum. Meaning, the only way early people make money is by new people coming in and buying at higher prices. It's not generating actual economic value itself. And they point to all the costs, the huge energy bills, the expensive mining computers. All that accumulated expense makes it negative sum overall.
And they compare it to MLM's Ponzi schemes.
Yeah, those comparisons come up a lot. Multi-level marketing, classic Ponzi structures, the greater fool idea. You only profit if you find a bigger fool to buy it from you for more.
Hang on. The counter-argument you always hear is, yeah, it crashes, but look, it keeps hitting new all-time highs. Bitcoin has recovered spectacularly multiple times.
And the Reddit thread acknowledges that, sure. But their explanation is that this number go up thing isn't driven by real value or use. They argue it's mostly speculation, maybe even manipulation, happening on these crypto exchanges that often aren't heavily regulated.
So just because the price chart goes up doesn't mean it's fundamentally sound or a good investment long-term.
That's their core point. They see the hype, the price action, and they draw parallels to how Ponzi schemes work initially, paying early investors with money from new ones, creating that illusion of success until it collapses.
It really forces you to question what's really driving the price, doesn't it? Fundamentals or just belief and momentum.
Exactly. Is there underlying utility, or is it purely speculative expectation?
Okay, let's talk about something more concrete. The environment. That LSE Business Review piece, the numbers are pretty startling.
They really are. That proof-of-work system Bitcoin uses is incredibly energy-hungry, around 63 terawatt-hours a year, they estimate.
Which is comparable to Poland, you said earlier.
Roughly, yeah. An entire country's worth of electricity. And if that electricity comes from burning fossil fuels, which it often does, well, that's a significant carbon footprint, a real climate change concern.
And the article breaks it down geographically, too, like where the mining emissions are actually happening.
Yes, it points to places like the U.S., Kazakhstan, and China as major contributors based on where mining activity is concentrated and the energy mix in those regions.
But it's not just the direct electricity use, is it?
Good point. The LSE article also mentions the indirect emissions. Think about manufacturing all those specialized mining computers, the servers, the graphics cards. That process has its own carbon footprint, often in places with carbon-heavy manufacturing. So it adds up.
No, I saw in the comments on that LSE piece, there was some debate about how to measure this, like per transaction versus total energy use?
Yeah, that's a methodological debate.
Yeah.
Measuring energy per transaction can give you these incredibly high, kind of shocking numbers. But maybe looking at the total energy needed to keep the whole network secure, the total hash rate gives a better picture of the overall environmental cost.
Yeah, it's complicated.
It is. And the article does briefly mention proof of stake as an alternative that uses vastly less energy.
Right, some other cryptos use that.
But then you get other concerns, like the Dankin.io piece, worried that proof of stake could lead to control by the wealthy, like a plutocracy, where those with the most coins have the most power. So no easy answers there either.
Okay, shifting again. Security. Those hacks mentioned in the Crystal Intelligence report. I mean, wow.
The scale of the losses is just mind-boggling. That report listed the biggest hacks on centralized exchanges. The top one, Bybit, apparently lost $1.4 billion in Ether back in 8th. Well, the report projects a future event, but the point is massive losses.
1.4 billion from one hack.
According to the report, yeah. And it's not just one or two bad incidents. You see names like Coincheck, FTX, and we all remember that disaster meant the Gox from way back.
Yeah.
Big platforms getting hit hard.
So these aren't small-time operations failing. These are major exchanges.
Exactly. And the report stresses that the hackers are getting smarter, more sophisticated all the time, so even big exchanges spending a lot on security are still targets, still vulnerable.
But the report also said there's more cooperation now between exchanges and law enforcement.
Yes, that's the positive side. There's apparently a growing effort to share information, work with blockchain analysis firms, and coordinate with police to try and track and recover stolen funds. But it's still a huge challenge.
So even though the underlying blockchain might be secure, these places where most people actually interact with crypto, the exchanges, they're the weak points.
They represent significant points of risk. Absolutely. You're trusting a third party with your assets, and that trust can be broken either through hacks or mismanagement like we saw with FTX.
Which raises that whole not your keys, not your coins issue again.
Precisely. Who's really responsible for keeping your digital money safe?
Okay, last big area. Government and regulation. Fama, back in capitalism, had that libertarian take, right? Government should stay out.
Mostly, yeah. His preference is less intervention. However...
There's always a however with Fama, it seems.
Yeah, well, he's pragmatic too. He predicts that if crypto collapses badly, the people who lose big will likely ask for government bailouts, and that could force the government's hand, leading to regulation after the fact.
Reactive regulation.
Exactly. And he agreed with Luigi's point about keeping crypto somewhat separate from the main financial system to avoid, contagion if things go wrong.
Meanwhile, you've got regulators like ESMA in Europe sounding the alarm bells pretty loudly.
Very loudly. Their warning is clear. Even with new rules coming in that MiCA regulation, crypto assets are still super risky.
They mentioned no investor compensation schemes like you get with bank deposits or stocks.
Right. If your crypto disappears or the platform goes bust, you likely won't get bailed out like you might in traditional finance. And the overall protections under MiCA, while a step, are less comprehensive than what investors are used to.
And they specifically warned about using firms outside the EU.
Yes. They flagged that as a major risk. Lower standards, higher chance of fraud or things going wrong if you deal with firms not subject to EU rules.
Now, that Capitalism chat also brought up stablecoins again. The idea they could be used to get around government controls. Referencing the Ottawa trucker thing, worries about debanking.
Yeah, that potential use case came up. But Fama and the hosts were quick to point out the flaw there, too.
Which is?
Governments can still just shut down the stablecoin companies. If they see stablecoins as a threat to their own currency or financial control, they have the power to intervene directly against the issuers.
So maybe not as censorship resistant as some hope.
It raises questions about how truly decentralized or independent these systems can be when they interact with the real world and existing power structures.
And regulation itself is tricky, right? Finding that balance.
Hugely tricky. You hear calls for clarity, for rules to protect consumers, but then worries that if rules are too tight, you'll just stifle innovation or push activity into darker corners. And then there's the whole crypto lobbying angle influencing politicians.
Yeah, that adds another layer.
And the Dankin.io piece made a useful distinction too, separating things like public Bitcoin from, say, government-backed digital currencies, CBDCs, or private permissioned blockchains used by businesses. They're not all the same thing. And they also worried about stablecoins relying on crypto networks that might themselves be flawed.
Okay. Wow. We have definitely covered a ton of ground here. Arguments for, arguments against Bitcoin's value, the environment, security hacks, regulation. It's a lot.
It really is. And the viewpoints clash quite dramatically, don't they? On one hand, this potential revolutionary tech. On the other, fears of a bubble, environmental damage, security risks, and this constantly shifting regulatory picture.
And you can't just dismiss Fama's argument lightly. A Nobel laureate saying, based on monetary theory, this doesn't work as money and it's likely going to zero, that carries weight.
It absolutely does. And when you combine that with the regulators like ESMA basically shouting, warning, high risk, even as they introduce rules, it definitely signals that investors need to be incredibly careful and critical.
Okay, so let's leave our listeners with something to chew on. A final thought. Given everything we've discussed, all these strong opinions, the fast changes, the tech, the regulation, what would actually need to happen?
What fundamental shift?
Yeah. What fundamental shift in the technology, or how widely it's adopted and used for real things, or maybe in how governments regulate it? What would need to happen to definitively prove or disprove that Bitcoin and crypto are here to stay?
That's a great question.
Think about the economics, sure, but also the wider impact on society. What would be the tipping point, one way or the other? What would finally settle the debate?